The Federal Reserve is set to announce its first interest rate cut of 2025 this week, a modest 0.25% reduction, aiming to ease economic pressures from a softening job market, though inflation remains a watchful concern. This cut could lower costs on variable rate debts like credit cards and auto loans, potentially saving you hundreds annually, but mortgage rates may lag behind. Act now, lock in high-yield savings before rates drop, and focus on credit score improvements to maximize benefits. Research shows even a 50-point boost can cut loan APRs by 1 to 2%. While promising relief, experts caution this is no quick fix. Multiple cuts through year-end could amplify effects, but broader economic headwinds like tariffs add uncertainty. What this means for your wallet right now. If you're juggling high-interest debt or eyeing a big purchase, this Fed move feels like a breath of fresh air. Borrowing costs, which spiked after years of rate hikes, are finally turning a corner. For context, the federal funds rate, the benchmark banks use, has held steady at 4.25-4.50% all year, but that's about to dip to 4-4.25%. This isn't just Fed jargon. It's real relief for everyday folks in the US, Canada, UK, and beyond, where central banks often mirror these shifts. Think about your credit card balance. At an average 20% APR, a $5,000 debt costs $1,000 yearly in interest alone. A rate cut could trim that by 0.25-0.50% initially, and more if banks pass it on fully. Auto loans? Similar story, rates hovering at 7 to 8% might ease, making that dream SUV a tad more affordable. Mortgages are trickier. They're tied more to long-term bonds, so don't expect a plunge tomorrow, but sustained cuts could nudge 30-year fixed rates below 6% by Q4. On the flip side, savers might see yields dip. High-yield accounts at 4.5% plus today could slide to 4% soon. The evidence leans toward prioritizing debt payoff over parking cash, especially with predictions of 3 more cuts by December. Refinance smartly. Shop rates now for variable debts. Tools like Bankrate show potential savings. Boost your score. Pay down revolving credit. Aim for under 30% utilization to qualify for the best post-cut deals. Lock it in. Grab a CD at current highs for 6-12 months to shield your emergency fund. For a deeper dive, check out my latest blog post on personalfinanceai.org. It's packed with calculators and case studies tailored for Tier 1 economies.
Imagine waking up tomorrow to find your monthly credit card payment just got a little lighter. Maybe $20, $50, even $100 easier to swallow without you lifting a finger. Sounds like a dream, right? Well, that's exactly what the Federal Reserve's first rate cut of 2025 could deliver for millions of us grappling with sky-high borrowing costs. But here's the catch. It's not a magic wand. In this video, my very first on the Personal Finance channel, shot in crisp 4K for you, I'm Michael, your guide through the maze of money moves that actually matter. As the founder of personalfinanceai.org, I've spent years breaking down these big economic shifts into actionable steps for real people in places like the US, UK, Canada, Australia, and Germany. Today, we're unpacking the Fed's upcoming rate cuts, why they're a game changer for borrowing relief, and how you can position yourself to win big. If you're tired of feeling squeezed by interest rates, hit that play button and let's dive in. By the end, you'll have a clear plan to turn this policy pivot into personal progress. Stick around. I've got stories from folks just like you, hard numbers from trusted sources, and tips that could save you thousands. And if this resonates, smash that subscribe button now for weekly deep dives on personal finance that keep it real, no fluff. Links to my Instagram and Facebook are in the description. Follow along for quick tips and community chats. Plus, head to personalfinanceai.org after the video for my full blog post on this topic, complete with free tools and worksheets. All right, let's get into it. Understanding the Fed's big move, why now, and what it really signals. Let's start with the basics, because I remember when I first wrapped my head around this. It felt like decoding a secret language. The Federal Reserve, or Fed for short, is America's central bank. Their main job? Keep the economy humming without overheating into runaway inflation or stalling into recession. One of their key tools is the federal funds rate, the overnight lending rate between banks. When they hike it, borrowing gets pricier to cool things down. When they cut, it gets cheaper to spark growth. Fast forward to September 2025. After holding rates steady at 4.25-4.50% for 9 straight months, the longest pause since the early 2000s, the Fed's poised for action. Their 2-day meeting wraps up tomorrow, September 17th, and markets are betting 96% on a quarter-point cut, dropping the target to 4.25%. Why the urgency? It's the job market. We've seen payrolls cool dramatically. Think August's report showing just 142,000 new jobs added, way below expectations, and unemployment ticking up to 4.2%. Inflation's ticked higher lately, thanks to factors like new tariffs under the current administration, but the Fed's prioritizing employment risks. Chair Jerome Powell's hinted at this in Jackson Hole. The time has come. This isn't happening in a vacuum. Remember 2022 to 2023? Aggressive hikes pushed rates from near 0 to over 5% to tame post-pandemic inflation. By late 2024, 3 cuts brought some relief, but 2025's been a holding pattern amid mixed signals, strong GDP growth on one hand, softening consumer spending on the other. Now, with election year politics in the mix, President Trump's even publicly nudged for deeper cuts, the Fed's walking a tightrope. Dissent's brewing too. Some governors like Michelle Bowman might push back, favoring a wait and see. But the consensus? This cut's a lock, and it's the start of easing. To put it in perspective, here's a quick timeline of recent Fed actions. I've pulled this from official FOMC minutes and CME FedWatch data for accuracy. March 2022, July 2023, 11 hikes. Federal funds range 0-0.25% to 5.25-5.50%. Key driver, taming 9% plus inflation peak. September, December 2024, 3 cuts, 1% total, 5.25-5.50% to 4.25-4.50%. Key driver, inflation cooling to 2.5%. January, July 2025, hold steady, 4.25-4.50%. Key driver, balanced but watchful recovery. September 17, 2025, expected 0.25% cut, 4-4.25%. Key driver, job market softening, unemployment at 4.2%. Q, for 2025, projection, 2-3 more cuts, 0.50-0.75% total, down to 3.25-3.75%. Key driver, sustained easing if growth holds. This table isn't just numbers, it's your roadmap. If history's any guide, think the 2008 cuts that slashed rates to 0. Sustained relief follows the first move. But 2025's unique. Tariffs could reignite inflation, per CNN analysis, making future cuts a maybe rather than definitely. How rate cuts translate to borrowing relief, the real-world breakdown. Okay, so the Fed flips a switch. How does that light up your life? Short answer, by making it cheaper for banks to borrow, they pass savings to you on loans tied to the prime rate, usually Fed rate plus 3%. But it's not instant. Variable rate debts feel it fastest, while fixed ones like most mortgages move slower. Let's break it down by category, with examples grounded in current data from Bankrate and NerdWallet. I'll share a quick story from my own circle to make it hit home. Credit card APRs average 20.13% right now. Brutal if you're carrying a balance. A 0.25% Fed cut might shave that to 19.88% on variable cards, but banks often lag, so expect 1-3 months for the full effect. Over a year on a $10,000 balance at minimum payments, that's $200-300 saved. Sean Piles at NerdWallet puts it bluntly, this makes debt more affordable, but don't stop there. Use the breathing room to pay down principal. Take my buddy Sarah in Toronto. She's Canadian, but our banks sync with the Fed. Her $8,000 Visa bill at 21% was eating $140 monthly in interest. Post-2024 cuts, she refinanced to a 0% balance transfer card and saved $1,000 last year. With this cut, she's eyeing consolidation into a personal loan at 10 to 12%. Pro tip. Check for intro offers now. Sites like Credit Karma flag them based on your score. If yours is sub 700, focus on utilization. Drop it below 30% by shifting spends to debit. Auto rates sit at 7.5% for new cars, 9% used, double pre-pandemic levels. A cut won't retroactively fix your existing loan, those are fixed, but new ones? Expect 0.25-0.50% drop soon, per JP Morgan forecasts. For a $30,000 loan over 60 months, that's $6,120 less monthly. Same for personal loans, ideal for debt consolidation. I recall advising a client in London last year, similar ECB cuts there. He waited out high rates for his EV upgrade. Jumping in post-cut saved £400 yearly. In 2025, with EV incentives stacking up, timing matters. Advice: pull your credit report free weekly via annualcreditreport.com or equivalents abroad. A 50-point score jump? That's 1% better rates per Experian data, potentially $1,500 lifetime savings on a car loan. Here's where it gets nuanced. Mortgage rates, 6.3% average for 30-year fixed, track 10-year treasuries more than the Fed directly. This cut might nudge them to 6.1%, but experts like Stephen Cates at Bankrate say, don't expect fireworks, anticipation's already baked in. Still, if we see 3 cuts by December, 76% odds per CME, rates could hit 5.75%, unlocking $200 plus monthly on a $400,000 home. Housing's frozen, inventory's low because no one's selling at a loss. Cuts could thaw that per Axios reporting, boosting supply and stabilizing prices. For renters eyeing buys, now's prep time. Save 20% down, get pre-approved. My blog at personalfinanceai.org has a full mortgage calculator. Plug in your numbers for personalized scenarios. In the UK or Australia, your central banks, BOE, RBA, are eyeing similar moves. Rates there could dip in tandem. Reading table data exactly as presented. This table's your cheat sheet, savings scale with debt size, but remember, it's cumulative over time. The flip side. What savers and investors need to know. Relief isn't one-sided. High-yield savings at 4.5% APY. They'll dip to 4.2% post-cut per Kiplinger projections. $40 less yearly on $10,000. CDs are your hedge. Lock 5% for 12 months now via Ally or Capital One. Mark Hamrick at Bankrate warns, this cut signals faltering growth, not victory, so diversify. For investments, stocks love cuts. SP's up 2% on cut buzz alone. Bonds, yields fall, prices rise. If you're in 401(k)s, tilt toward growth funds. My blog dives into low-cost index picks. But caution, volatility's high with policy shifts. Drawing from years counseling clients, here's a no-BS roadmap. Audit your debt, list balances, rates, use Excel or my free template on personalfinanceai.org. Prioritize high APR cards, credit tune-up, dispute errors, pay on time. Apps like Mint track progress. Hunt better rates. Compare via NerdWallet. Refinance if savings top 0.5%. Build buffer. Stash 3, 6 months expenses in a high-yield account before yields fade. Long game. If buying a home car, monitor weekly. Cuts compound. Real talk. I bootstrapped my finances post-2008 crash by obsessing over rates. One small refinance snowballed into financial freedom. You can too. Wrapping up, your next move starts here. Whew, that was a lot. But knowledge is power, especially in uncertain times like 2025. The Fed's rate cut is a step toward borrowing relief, easing the squeeze on credit, cars, and homes. But it's on you to act. Head to personalfinanceai.org for my in-depth blog on Fed Rate Cuts 2025, Borrowing Strategies for Tier 1 Economies. It's got exclusive forecasts, reader quanda, and downloadables. If this helped, comment your biggest takeaway, mine's the CD lock-in, and subscribe to Personal Finance for more. Next up, tackling student loans in a low-rate world. Links in the description. Follow me on Instagram at Personal Finance Michael for daily tips, and like our Facebook page for live quandas. Thanks for watching in 4K glory. Drop a hello in the comments, and I'll see you next time. Take care and remember, smart money moves today, build tomorrow's freedom.